What's up everybody, Tom here with another video. Well, it's day 2 of super earnings week, and of course that means Microsoft and other big names have come out with their earnings, and Microsoft was the diamond in the rough, earnings topping $20 billion in a quarter for the first time, and of course the stock actually ended a little bit higher in after hours action. Now, it wasn't across the board, and we've got a lot to discuss in terms of what the market's expecting, where their current expectations are, and how many of these companies are actually now missing or not quite beating the expectations. Will that cause a small dip in the markets? Stay tuned to find out more. All right, guys, well, one of our first stories for the day, I think we'll go through some of the big earnings that happened after hours. Of course, Google earnings did also top estimates, but maybe not by quite as much as the Microsoft ones. And online sales ads remained resilient. I still expect Google to do well over the long term, but it wasn't quite in the, let's say, the echelons of what the market expects. Remember, when you're thinking about optimism in the markets, if you have a scale between 1 and 10, most of the market of the time, it will have, let's say, the guidance or their estimate of what people think. The stock market generally likes to be around a 7 to 8. So you've really got to smash expectations to get bigger price action. Remember, always have a look at the left-hand side of your screen to see what's happening first. If you've got a stock going like this into earnings, if it doesn't smash expectations, what often happens? If it just hits, it'll actually decline. Remember, left-hand side, really important. Buy the rumor, sell the fact. All of these types of things go into many different stocks out there. We've demonstrated that on this channel with Apple several times. Other big names such as Robinhood, the shares of the stock trading app obviously declined here around up to 9% after hours. They reported 365 million and the analyst expectations was 432 million. An interesting one there, but not unexpected. We never liked the old IPOs in the US market. If you're in early on IPOs or you trade it the first couple of days, fine and well, but it can take around that 12 to 18 months to stabilize. And it's something that I think a lot of people should go back and have a look at. If you think about Facebook, if you think about Snapchat, if you think about Twitter, all these different, especially technology companies that come into the markets, they do have a rough 12 to 18 months. Even Airbnb, fairly rough 12 to 18 months. Dropbox, you go through and have a look at quite a few of them. Microsoft, we've talked about that there. Enphase, of course, doing well as well. 7% up in after hours after they did a pretty good number, 351 versus a 345. AMD also advancing here, showing that it's really got a robust business. It's smashing Intel at this stage, and they've done quite well. A little bit up after hours, though it was quite around. And I think the interesting one that isn't here is probably going to be Twitter. If you actually have a look at a Twitter chart in aftermarkets, we were watching it live. It was down as much as almost, I think, 4 or 5% at one stage. Then it went up about 2-3%. It's been very volatile. And what this means is, as we expect, huge amounts of algorithms are in the markets at this stage, and they're trading that aftermarket. Make sure if you've got stop losses or you're thinking about it, sometimes it's better to practice risk management, because if you have an aftermarkets account, you were trading Twitter and you didn't have the correct stops, you could have very easily gotten clicked out there. Your trade's a loss or a win or whatever it might be, and all of a sudden you're sitting there going, what just happened? Remember, risk management is always number one key, and that's why people sometimes need to calm down in these times of big earnings. Wait for the earnings to come out, then see the technicals take over and trade more of that before the market, before the earnings, and after the earnings scenario. A lot of people use options to, of course, risk mitigate, but you've got to think about that. Let's go in here to the S&P 500 and the large companies here. This is a heat map of all the big ones. Of course, Facebook actually surprising here. So it looked like it was up market, up in terms of aftermarket post the initial reaction. By the time the market had time to digest, look at the report, they actually opened basically at the same price they closed in the previous session. Then they sold it down and actually broke past support. So Facebook, a very interesting story there. Obviously a lot of conflicting messages between current earnings and future problems, and of course government risks and all sorts of things. Amazon had a good day. Tesla went bonkers in the morning, then came back. The story probably isn't told here. Microsoft, Apple, etc. obviously coming up slightly into the back end of the day. And it was really just a muted, nothing really too strong, nothing too weak. And you can show it here. The initial ramp caused by a bit of FOMO, euphoria, everyone feeling good. The sell-off by Wall Street, and then the sell into the close at this stage, basically ending as flat as it could be. S&P 500 0.81% or 0.18% and 0.29% from the Nasdaq. Let's have a look at the sectors which were doing best. Energy doing well, utilities, healthcare. We're going to talk about healthcare a little bit later just in terms of sector rotation. And then XLP, XLRE, quite a lot of defensive sectors doing better for the session, and the rest of them, XLC and XLI, industrials, etc., being the worst for the day. So we're in big earnings week, and this means that we continue to see a lot of volatility. This means we continue to see a spike in things like the VIX, which we'll talk about, and we have a lot more spiking to be done because we have Apple, Amazon earnings Thursday after the close. We've got Exxon, we've got Teladoc, Twilio, Ford, McDonald's, Coke. I mean, it just doesn't get bigger than a week like this. These are the big names, and this is what moves the markets. Before we get into the technical analysis, I want to talk about seasonals. And we talk about seasonals all the time here on the channel. It's a good stat to bring into the base of your psychology and also, of course, your technical analysis. And this is something that's in our public Discord community. One of the members there shared this chart, and I thought, well, it's a good chart to really demonstrate what's been happening this year. So you can see the pullback that we expected. This happened in September into October, and that's pretty average here on the chart. Then we have that big ramp through the middle of October, very similar to what we've seen so far. And where are we right now? We're basically here, yeah? We're basically here, so a little bit of a dip somewhere in this zone. If we then have that big ramp in November, let's just say it happened like this, then we get that dip back, probably coming back to the previous highs, and then, of course, further ramping into the end of the year. There's no real reason at this stage, based on seasonals, based on what we know about the market, know about corrections and markets coming out of it, to think that any of these, let's say, little pullbacks will be anything more than dip opportunities at this stage. And I think this chart really demonstrates the standard seasonality of markets and the strength that generally markets have through that October into November period. And we've discussed this a lot on the channel. Let's get into the technical analysis. We'll talk about the VIX here first, the volatility index. It spiked up. It went a bit higher than 16. I think at the high it was 16.71. That's coming off the base that we've traded a few times now. We've talked about this 15 level being a key zone of potential buying for volatility. It doesn't have to go down, as in the market doesn't have to go down to force volatility. Remember, earnings season in itself is volatility. It is a huge amount of big news that can move the markets around. And as we see that news come out, especially if it doesn't exactly hit expectations, it can cause these spike ups. So we have a look at the daily here. You'll notice it's finding base around this point. If Apple or Amazon or something missed heavily, you would expect, of course, a rise in the VIX, that to cause a little bit of a dip. But most of these VIX trades, if you ever place them, they've got to be short and sharp. They've got to be very quick because it's too expensive to hold the VIX. If anyone's ever done that, let us know your experience in the comments down below. It will help other traders out there. And on top of that, it's also not really one of those really good long-term positions. I mean, if it was as easy as buying the VIX at 15 and waiting till it spiked to 20, anyone could do it, yeah? It's about the holding cost. It's real, and you can go and look at inverse VIXs or VIX ETFs, and you'll see the degradation over time. The dollar index also really powering up here, coming off a very key level. Previous resistance became support. We've got a beautiful base formation here, and it's closed above the 20 moving average. So let's just quickly scroll down here on the 4-hour and think about what's happened there. And I think quite a lot. Firstly, our downward trend line got smashed above. We've got a triple bottom base that's now broken. It's now retested, and it's looking at all-time highs in terms of, the recent trade here, new highs at this stage. So we break through this level. We then move back up to that 94.50. If we get through 94.50, well, you know what that means. It's a very significant thing for the dollar index and could mean a little bit of risk off in the markets. And just in general, some good trading throughout the currency markets and other commodities markets, etc. This will create what you would think is a bit of participation, and it certainly will become the storyline in many newspapers. This will be the big key point. 94.50 remains the key resistance here for the DXY, the dollar index. Let's now talk about some stocks. We'll start off here with Tesla. And when we bring up Tesla, well, that was a big ramp followed by a bit of a sell-off, hey? So 1,100 almost hit here for Tesla. A few people I saw on Twitter were like, oh, my portfolio went up so much yesterday. Congrats to those guys. Obviously, it's great to be in profit, but at the same time, we need to understand what this is. And that is most likely a bit of a sugar rush created by the Hertz news, created by, no doubt, a very pivotal point for Tesla. But that's not exactly the best looking candle. I mean, it basically is a shooting star or pin bar reversal style candle. We might see some consolidation here, possibly even to fill the gap and then pick back up. I think things are looking very positive for them. I think this is a huge news with Hertz. It's more than just, a sugar rush there. You start to think about Avis, you start to think about all the other car companies, and more importantly, just in general, a huge fundamental shift possibly for corporates. What if they all start buying Teslas and using, instead of the traditional Toyota, Honda, whatever they might have, or in America, obviously different cars, they might say, okay, let's get Teslas instead. We'll look green, we'll look cool. It's become cool and hip to do those things, and this is the gateway for that. So yeah, big deal there, along with everything else. Not a great looking candle, but I think investors won't be too concerned about the small stuff. They'll be focusing on, well, my stock's up a lot over the last week. It kind of reminds me of the session over here where we had some ramping. So we went pretty big candles, and then all of a sudden we got that monster candle, and then we get some consolidation. I'm not saying it's going back down like this, but I do think some consolidation wouldn't be bad for Tesla. And we'll keep following it, and we'll try to find some better key technicals when we get a clearer story. At the moment, it's very rampant both ways, and you've got to be down in the 5-minute, 15-minute chart to really make sense of it. Not really worthwhile doing in the daily recap video. Let's go over Apple here, and Apple hits the 150 again and finds resistance. We know this 150 area is super pivotal in terms of resistance. It looks like we might be around this level coming into the earnings, and then we'll find out whether it's too much for it and it sells off, or it closes above and begins some nice ramping that we can get involved in. It's really a coin flip either way. We know they've got some concerns about semiconductors. They've got some concerns about, in general, supply chain issues. And this resistance, I think, is showing that. There was a bit of a buy the rumor. Will it be a sell the fact? 150 is going to show it to us. And of course, there's a lot of options around here, but we've already detailed how important the 150 is. And I think we've ascertained this is a great zone, a very important zone. We have some support here around that 146, should it occur. And then, of course, we've got that breakout level that we're looking for new all-time highs. Again, should it occur come the earnings. We'll follow it on the channel. XLV, this is the healthcare sector. We saw also IBB, which is the biotech sector, do very well and start to break out of key levels. I wanted to talk about this because I think not enough people look at sectors. And sector rotation is a big thing I talk about in my mentoring. I talk about in general. It's something I've followed for years. And I think we're getting into a market where you can't expect 22% from an S&P 500 every year. And when you start to talk about, let's say, 6% or 7% years or 5% years, a lot of you will be like, oh, that's boring, Tom. I don't want to talk about 5% years. That's when sector rotation really comes into play. And you need to understand that Wall Street, to make more money, rotates through these different sectors. And when you know the seasonals, when you start to play the statistics game, it can be a lot better. Healthcare still got a lot of catch up here in its previous highs. You've got beautiful base formation here, a great closeout, and of course, pullbacks to something like that 130 would be very, very interesting. Why I want to bring it up is because there's always an opportunity in an opportunity. If you think you've missed an area, then you can bring in different sectors and have a look at the way that they're breaking out. IBB also breaking past a resistance, still struggling around this area, but look how far away it is from where it's been previously. It's quite far down. So these are the types of things that can start to ramp. And if you miss one sector, you can go find another one as it starts to be rotated into and possibly get an opportunity. Let's now talk about the S&P 500. We'll get rid of this trend line now because I think it's probably partially irrelevant since we've broken past it. We created no doubt, a pin bar or shooting star style candle here on the close. This is the real market, the SPX. And we are quite far away from the daily 20. It's almost due a pullback. Remember, daily 20 pullbacks are very, very normal. Whenever we get too far away from the 20, no matter how it's been, we do like to come back to the 20. The further we expand away from that, the more likely we actually go to the 50 because we've gone just too far. So similar to this style scenario. So when it starts ramping, it's no problem to be in it, but you've got to expect all of a sudden, instead of the 20, if it goes way too far away, then we get the 50. You get that deeper pullback to just allow it to kind of compress and say, okay, yeah, slow down there, cowboy. That's too fast. That's too quick. When we get that, we know at this point, if you're feeling the FOMO, which many people are, if you're in it, cool. Look, still looks fantastic. Still the seasonals are behind you and everything. But I would love to see this right now. I would actually think this would be fantastic. Not will we just close a few gaps, but it would also be quite healthy to the market. It may not happen. This is only one sign of slight bearishness coming through, and it's really more the Nasdaq that we'll probably be watching, but that's the first weakness sign. Aftermarkets, it's actually gone back up. I'll get a little bit here. So it's 55.79 in the aftermarket. And yeah, it's just that first sign of a little bit of weakness coming off earnings. And often people get hyped into earnings, and then straight after the big earnings happens from Apple, Amazon, Facebook, Microsoft, etc., a little bit of the hype and the anticipation comes out of the market, and it goes back to trading really technical, and that's what we love. We love the technicals whenever possible. Similar scenario here, SPY, you'll see the area. If it did happen again, I think there'll be a lot of buyers there, and Wall Street will be pretty interested. And we do need to consider the volume has dropped off considerably here with these new peaks. Great peaks, fantastic. If you move to the buys around here, well done to you. But Wall Street likes a second chance. They love grabbing a second chance and scaring a lot of retail out. It's no different on the QQQ. We take a look at the QQQ here, hit the peak. Few people would have sold that level right into the peak. We still maintain really a longer term idea of getting it back up to this trend line, but possibly a little bit of a dip off. Now that we've hit this high, if again Apple doesn't present good earnings, or Amazon fails, or any of those types of ones don't hit expectations, we could see that pullback. And we've got the key kind of lines up here. So we've got that 2050 kind of level sitting around now, the 370-ish zone for the QQQ, and then we've got the 374, and they're going to be some of the key zones that people look at. Still in a gigantic channel up, this ascending channel, very strong across the board. And the great thing about this is, as it acts technically, what else do we get? We get technical take profits for our longer term swing approaches. And that's what I love about technicals. You get this opportunity to actually make really great informed decisions, know where you are in the potential little bit of the cycle there, or the sector rotation. And it's fantastic across both the Nasdaq and the QQQ. So another level here, key zone that we're looking at, focusing on that 2050. Good stuff. Should it come down, of course, you guys will hopefully have a plan built around that. Let's move over to Bitcoin. This is dropping, and it is dropping not super fast, but certainly dropping back down. Look, we know that Bitcoin's gotten a lot of favorable press about it. All of a sudden, it's the second coming. It's the best. It's going to do this. It's going to revolutionize this. Hey, 1.5 months ago, I thought everybody hated Bitcoin. How does this happen? Because it's part of the machine. It's part of psychology. When everyone thinks about buying it, everyone's so happy about it. That's usually when you've got to expect that standard crypto 20% pullback kind of range. And we did pull back from about the top to the bottom here, about 10%. We know 20% is quite common. I've detailed a few times the importance of this level. So this just under 60,000 level looks like it's about 59.6. This is going to be a very important closure. If this market tanks underneath this zone, what happens? The whole market probably moves down to like something around that 54K. If that occurs, let's just measure out the percentage there. What is that as a percentage? Oh, what do you know? It's around 20%, guys. Exactly what most people expect from crypto market declines. So should we get back down, we hit the 4-hour 200, we hit previous support, we hit around that kind of level that you could see being a bit of buy pressure. And it's very, very common. Look at the 50 exponential here on the daily. And again, we go back over, we look at the weekly as well. It needs to have a little bit of a breather. We've got that weekly huge pin bar rejection. This is a nasty looking candle. This is standard. This is exactly the kind of way that we work usually in markets. You've got your first leg up. You've got your second leg, slight over expansion of the leg. Let's think about the pullback. So the pullback was this length last time. There's the length pullback. What does that come into? 53, 54. That's where a lot of the big whales may be targeting for their Bitcoin, for their Ethereum. So just remember, pretty normal. This is the type of thing that happens when everyone gets hyped. It's time to possibly pull it back down. It doesn't mean that I don't have big expectations for Bitcoin into the end of the year. I think a lot of people do. But this is the type of thing you've got to think about. And of course, it all comes down to this 59,600, 60,000 area. How that's supported by the market, I think will be very, very important. Thanks so much for watching, guys. If, of course, you enjoyed the video, please remember to subscribe, smash that like button, and in the comments down below, what's your next price over the next couple of days for Bitcoin? Do you think it's going down to something like that 54, 53? Or are you just saying, nope, Tom, to the moon, we're getting a 70 plus in the next couple of days? Let's see, guys. Thanks so much. Catch you in the next video.